Hello, everybody out there in Rosedale's family office, and welcome to the, final market outlook for 2024, navigating the markets after a post-election. Is it after a post-election, or is that a double? Anyways, I'm not going to say anything about that, but I think it's after the election. So we're gonna find out what we're going to be doing in 2025, and I'm very excited about this. We have Himalaya Jain going to tell us what path we're headed for and why we're probably going there. And we got Ian Love there, who's going to be asking a few questions. If you have questions, and send them into Ian, and he'll either send them forward to Himalaya or he'll cut you. No, I'm just kidding. He wouldn't do that. Anyways, it sounds like it's going to be a very good presentation. This year, I just a couple of things I wanted to say about the season's greetings. And this year, instead of sending flowers out to everybody, we decided we'd make a donation. Made a donation to the Kids Helpline. Kids Helpline is a 24/7 helpline for kids with mental illness, or just actually people who want to talk to somebody confidentially across Canada. And we thought this year that would be a better use of our funds versus sending out the flowers. So you should be receiving something in our letters that'll be coming out in the next little while. The only problem is Canada Post has a strike on, so you may not get that. Anyways, welcome to our market outlook. I don't know if everybody remembers what happened in 2024 or even 2023. I think if you think about it, 2022 was terrible, and then 2023 was even terrible until about October. So it's amazing what happens in markets. Markets are crazy. They never do what you think they're going to do, and what it takes is somebody who has patience, and you've got to believe in something, and then you take your stance, and then eventually these things happen and come to fruition. So I think 2023, you think about it, October, we didn't make any money until October, November, December, and then once that was, everybody was kind of happy. But 2024 has been a phenomenal year in terms of the markets. We've done a great job, and hats off to Himalaya and the team in terms of sticking to their guns. I'm sure there was times when they said, we don't have enough NVIDIA, which we did own at one point, but we just don't have enough of it. And we wish we only had that stock, but that's not the way you invest money, and that's not the way you reduce risk. So I think what happened at the beginning of the year was a little concentration on a number of different stocks. And now what we're seeing is a really good broadening out of some of the market. And, if you just looked at, you own CIBC, which is a great bank. It was up 5%, I think, today, or it was 6%. And it, produced some great numbers. We also own Scotia. Scotia was down a little, but then it popped back up. But, both those banks pay a great dividend, over 6%. Maybe it's come down a little bit now because of the price, but because the price has gone up. But really good Canadian, dividends in terms of what they're paying, and that's what I'm talking about, a broadening out. It's not just tech, which we do own some tech, but it's not only tech that's going up in the market. So you continue to hold these things despite what you hear in the news, and sometimes you get a little not crazy, but you get a little worried because you don't know that shiny object over there, which everybody seems to be talking about. So it's not an easy job, Himalaya, that you have. I can't see it, but eventually I will. But anyways, I want to say, thanks for all the great work you've done this year. You and Ian, I'm not going to name everybody: Noah, George, Sarah, Julia. Who else is in there? Zoe. I've probably forgotten somebody, but Scott, and Steph, who's back there, who actually has been running things ever since the beginning of the year. So, first of all, I want everybody to have a great holiday this year, but I'm going to pass it over to Himalaya, and he's going to tell us what's going to happen in 2025, because the past is easy to talk about, but really it's 2025. That's what we want to know, what we're doing and what we're thinking. So I look forward to hearing all the good stuff from you, Himalaya and Ian. So thanks, guys, for doing all your great work.
Right, thanks, Gord. We've got a lot of ground to cover, so I'm going to jump right into it. So as Gord mentioned, markets, of course, are volatile even in the best of times. But when you think back to last year, Gord mentioned, things really started to pick up towards the fall. And what really drove that was interest rates. Interest rates are still the most important driver of markets over the medium term, over the long term. So when we saw that rally start at the end of October last year, it was driven because interest rates looked like they had peaked, and it was really now a question of when and how fast would they start to come down. And throughout this year, in the first half of the year, that thesis held. And in the second half of the year, of course, we've already seen interest rates start to come down more aggressively in Canada, less aggressively in the US. But what's really important is that interest rates are now finally starting to come down. And that's really at the crux of what is going on in the marketplace. Of course, I have to talk about what's happened south of the border. That has changed the outlook moderately. It's not like we've thrown out the game plan completely and have to rewrite it. Because when you think about the bigger picture, what drives market returns, it's things like corporate profits, it's things like consumer spending, it's interest rates, as I mentioned. And all of those are going in the right direction. Interest rates are coming down, that lifts asset values. We've got a consumer who's getting back on their feet on average, not everyone, but on average, consumer sentiment is improving, and corporate profits are healthy and rising. So those are the essential building blocks that we base our outlook on. Now, of course, the election results in the US have gotten us to further tweak our positioning and our outlook. And as you'll see later on in the presentation, what it means is that the US equity market is likely to perform much better than other equity markets. And that's why we've been leaning into the US market, and most of our added equity exposure has been in the US. So overall, the tailwinds that we've been experiencing in the form of lower interest rates, things like that, they will continue into 2025. And that's why we are optimistic on the outlook. Okay, so an event happened on November 5th in the US, and we're not taking a position on the politics of it. Our job is always to interpret what it means for the economy, what it means for things like trade, what it means for eventually the market and your portfolios. And ever since the election, things were already moving in the right direction. And post-election, with the results, the market is interpreting these results as being very friendly to at least North American equity markets. Let me fine-tune that even further to the U.S. equity market, mostly, somewhat to the Canadian side. And as you'll see here, as far as the asset class performance since the election, so from November 5th up until last Friday, you can see already the market starting to decide who may be the initial winners and losers of the outcome. So think of this as more of an adjustment process. So what you'll see here is on the left side, most of the gains since the election have been in the U.S. Stock market indices, things like the Russell 2000, best performing. That is an index of small cap U.S. stocks. What may surprise some of you is that the TSX, our main stock index here in Canada, is actually performing very well. And that's despite this period covers last Monday's surprise tweet from Trump that he'd be considering a 25% tariff on Canada. So despite that, Canada is still, our stock index is still performing actually better than a few other US stock indices like the S&P 500 or even the NASDAQ. Again, this is as of last Friday. So it's not as simple to say that tariffs mean bad news for Canada. A lot of it does depend on what your starting point is. Canada was priced very cheaply from a valuation perspective. There are some elements in Trump's policies that may actually benefit the Canadian equity market, and I'll get to that in a moment. So, and then on the other side, you see a lot of the other international markets where we don't have any exposure. They have not fared well since the election. So Asian markets, Europe, they've all traded down. Now, at some point, it's not that we're going to stay away from those markets for the next 4 years. At some point, the valuation will become very compelling, and or the tariff situation may not be as dire as what the market is pricing in, and that may present an opportunity. But for the time being, our focus is really on the U.S. equity market, a little less so on the Canadian market, and essentially we're not exposed right now to the international side. Okay, so when you drill down a little further, again, since the election, and you look at, well, where has the strength in the equity market been? On the left side is the S&P 500's 11 sectors. On the right side, the TSX. One sector that will pop out right away is the financials. So in the US, the financials have been the strongest sector since the November 5th election. And it's not that suddenly banks are making more money, but one of the policies that Trump is likely to enact is deregulation, or not enact, but over his administration, they stand for a reduction in the regulatory burden that industries face. Financials and banks in particular do face an ever increasing amount of regulations, and the expectation is that some of those will get rolled back, and that's why banks have performed very well since the election. Same thing in Canada, second best performing sector in the TSX has been the financials. So again, the banks have done very well in Canada. And again, I will speak about that in a moment. Okay, let's jump right into the three main policy thrusts that really are, I would say, market moving at this point. Of course, there's going to be a lot more details coming in the weeks and months ahead. But these three main policy thrusts under Trump 2.0 are fiscal policy, there's going to be tariffs, and deregulation. And what you'll see is under every scenario, market implications are that the US equity market is going to benefit from these policy initiatives. So on this first one, on fiscal, what the incoming administration is campaigned on is a reduction in corporate taxes, reducing them from 21% down to 15%. They are also talking about reducing spending. Now, I'll get to spending in a second, but just on the tax side, a reduction in corporate taxes is that corporate profits will rise. So it's not just a one-time hit, though. As the US becomes more competitive from a tax regime on a global scale, it could have the potential of attracting even more global capital to invest in the US because of the lower tax environment in the US. On the spending side, they do have some ambitious goals to cut spending pretty aggressively. And should they achieve that, that could actually result in not just a more balanced budget in the US, but it could actually result in lower interest rates. Concern right now, and the reason why US interest rates are still fairly high, is there is worry that they're going to cut taxes but not spending, which would result in higher deficits, which would result in a much higher borrowing necessity for the US, and therefore they would have to keep interest rates very high. So bottom line, market implications from a fiscal policy perspective is good for the equity market, potentially good for the bond market, but that depends on if they achieve their spending reduction goals. Just to give you an idea as to if they are able to reduce their corporate taxes down to 15% from the current 21%, how does that put them on a global landscape? As you can see here, already the U.S. corporate tax rate at 21% is lower than the global average, and a further reduction down to 15% would make them even more competitive from a global perspective. I think we've got a question.
Thanks, Himalaya. We do. First
Sorry.
one of the night. So please fire them away. Anytime you got one, please put it in. I think they just mentioned it. Put it on the Q&A tab, or obviously email us at roastofthefamilyhouse. But the first question is, Himalaya. This is very interesting for the U.S., but where would Canada sit on this chart?
Yeah, good question. Because to remain competitive, with our next door neighbor, we do need to have a competitive tax rate to keep businesses based here. So the federal tax rate, corporate tax rate in Canada is actually 15%. However, there's also the provincial tax rate, which varies from province to province. If you just use the average across the provinces, the all-in corporate tax burden for Canadian corporations, it's in that low 20% range. It's be kind of in that 22, 23% range. So currently, it's fairly competitive with the US at 21%. But if they were to reduce down to 15, then suddenly we would no longer be competitive, and there could be pressure or opportunity for the Canadian government to reduce corporate taxes to maintain that competitive balance.
Thanks, Himalaya.
Yeah, keep those questions coming in. Okay, tariffs. That's the second. Not that there are any specific order of these policy initiatives, but tariffs are something that Trump 2.0 will continue to focus on as well. Just as they did in their first administration in 2016, they talked about tariffs. But what we learned from 2016 to 2020 was the threat was always larger than what was actually legislated. So, we went through a renegotiation of NAFTA, and we did come up with another agreement. Incrementally, there were more tariffs, but it wasn't a game changer. And same thing this time. We expect, despite last Monday's announcement of a potential 25% tariff on all Canadian exports to the US, and Trump has talked about 100% tariffs on some other countries if they drop the dollar from their trade, 60% tariffs on China. A lot of threats are being thrown out there. What's important to us is to separate the threat from what is likely going to be initiated. So when we think about, okay, what's the initial market reaction of all this? So overall, it is another net benefit for the U.S. equity market because, again, if tariffs are initiated, it will result in a reduced economic outlook for all other trading countries because they just won't be able to export as much into the U.S. And the U.S. will actually be a net beneficiary if a lot of the production actually does come back to the U.S. So directionally, good for the U.S. equity market. Rest of the world, maybe not so much. But again, it's not as easy as that. And you really have to dig into a lot of the details. Sorry, there's another question here.
You asked for questions, Himalaya. They're coming in. So the next question, just based on all of that analysis that we just talked about there with regards to tariffs and the 25% that Donald has thrown out there, and obviously the chart that we're looking at here, do we expect that the 25% tariffs on Canadian goods will become a reality?
I think it is a matter of probabilities. I think the probability is very low that they will apply 25% tariffs across the board. Now, there are a few trade categories. A lot of them have to do with agriculture that the U.S. has historically had problems with. Those that may not be aware, Canadian agriculture industry, so things like milk and cheese, it's very highly regulated. It's almost like a monopoly where producers are able to charge a certain price, and competition from the U.S. is kept out, or they have quotas on that. So the U.S. is not, they don't like that. They want a more freer trade environment. So there are certain segments of the Canadian economy that could be net losers from a tariff perspective. But overall, we think the threat is actually much lower than what the headlines are suggesting. The main way we get comfort on this is look at the Canadian dollar. So just as we talked maybe in previous webinars about, when there's conflict in the Middle East, we look to oil prices to be the gauge as to what the real threat level is. So same way right now, if you look at the Canadian dollar, last Monday on November 25th, it closed at a level that is just moderately higher than where it is today, meaning Canadian dollar hasn't budged very much over this 10-day period or so. So that is our way, that's our barometer for what the global market is thinking what the threat is to the Canadian economy. If the threat was perceived to be much more significant, Canadian dollar would have lost materially more than it has.
That's interesting. Good gauge to follow. Thanks, Himalaya.
Okay, so I wanted to drill down a little bit further because Trump purposely or specifically mentioned Canada in his tariff threat, which caught a lot of people by surprise. And it caught a lot of people by surprise because the perception and the reality is that Canadian trade with the U.S. is actually a lot more balanced than what many will think. So what we did was we looked at last year's total trade numbers with the U.S. and there's literally dozens of categories of products that cross the border. We just looked at the top 14, which account for about 75% of total exports to the U.S. So these are these 14 trade categories. And what we did was we looked at the amount of exports to the U.S. and we looked at the imports coming in from the U.S. And with the exception of oil and gas, where there is a very large trade imbalance, meaning we sell a lot more petroleum products to the U.S. than we import, when you look at the other categories, the balance is actually not that distorted at all. So the second biggest category is vehicles, the auto industry. We export just under $60 billion worth of automotive, either finished products or parts. And at the same time, we import almost the exact same amount. So if they were to put some tariffs on autos coming from Canada and going into the US, and it would be fair for us to then put the same level of tariffs on US exports coming into here, there's no net beneficiary. So unlikely that they would tax or put tariffs on an industry like that. As you go further down this list, what you'll see is that, again, there's not a lot of trade imbalance. In fact, in the next category, machinery and equipment, more value-add items, we're actually importing more from the US than we're selling to them. So again, you do have to go beyond the headlines. The headlines can be very scary sometimes, but when you drill deeper into the actual trade data, what it tells us is that there is a lot more balance across very many product categories than what, and again, what the headlines would suggest. Okay, just moving on to the third major policy initiative, which is deregulation. So this one is not as quantifiable as, say, a reduction in corporate taxes. This one is more subjective, but from a business perspective, it is considered more friendly to the business community. When you reduce regulation, it encourages investment. It encourages companies to expand and to hire. So the industries that we think are going to be the biggest beneficiaries are things like banks. So I've talked about those before. If I talk a little bit more specifically about it, what deregulation for the banks means is they may not have to put up as much capital as they currently do. Right now, there's a global renegotiation going on that would have required, or may still require, we'll see, global banks to put up an even higher amount of capital on their balance sheet. More capital means less money to lend out, which means less profit. So under Trump 2.0, the market is now starting to price in a lower probability of this negotiation moving forward. So that's an example, a very tangible example of where deregulation can help industry profits. Of course, there's discussion on the energy side to make it friendlier for U.S. energy companies to operate. On the technology side, we've seen lots and lots of, I would call interference lately, whether it's the Department of Justice or the Federal Trade Commission, wanting to, break up large U.S. technology companies or prevent them from buying other companies. So the deregulatory environment could, not saying that it will, but it could result in less interference going forward. So again, net impact to the market, again, positive for US equities, and there may be some spillover effect to some global equities like Canadian banks or even international banks, because the capital regime is more of a global banking regime rather than just something in the US. So some potential spin-off effects for other countries as well. Okay, so let's step back from some of the election-driven changes or reactions in the marketplace and move away from equities onto interest rates. So as I had said earlier, the biggest tailwind that we see that has helped markets in the past 12 months has been the expectation that interest rates will start to come down. And earlier this year, they actually did start to come down. What the election did was it has altered the market's expectation of the path that rates might take. So as you can see here, the Federal Reserve rate right now is sitting at 4.75. Just prior to the election, the expectation was that they would keep cutting at a sharper pace, bring rates down to about 3.5% by the end of next year. That calculus has changed a little bit. The market is now pricing in a bit of a shallower path. Shallower, why? Because some of the policies that Trump 2.0 may bring higher inflation rates. So again, not saying that there will be higher inflation, but the market is concerned that tariffs could cause slightly higher inflation in the US. Things like if they cut taxes, but they don't cut spending, that could be inflationary. So the market still expecting interest rate cuts to come from the Federal Reserve, but maybe not as many and maybe not as fast as what was priced in just prior to the election. But again, big picture for us is that we are in the downward part of the interest rate cycle, which historically has been a good time for asset prices. In Canada, Bank of Canada will meet next Wednesday. The question really is, do they cut 25 basis points or do they cut 50 basis points? We'll get some better clues tomorrow when the jobs numbers for November come out. But as you can see here, not much has changed from prior to the US election versus now. The Bank of Canada is still expected to cut numerous times between now and the end of 2025. And this is part of, or probably the largest contributor to the Canadian equity market starting to perform better, is that lower interest rates will stimulate the economy. That's their main job. And that creates a much better economic outlook when we look into 2025. It's actually that simple. That lower interest rates It's good for businesses, good for consumers, stimulates spending, and that's why the outlook has been positive for the Canadian market. Okay, we've been getting a lot of questions about the Canadian dollar. Where is it headed? So, as with some other things, we look to Trump 1.0 to give us a little bit of guidance as what we can potentially expect under Trump 2.0. Because remember, it's the same type of policies, lower taxes in the US, lower deregulation, and tariffs. So when we look at what happened from 2016 right up until the pandemic started, the Canadian dollar initially did react negatively in the first, call it 3 or 4 months. Canadian dollar did drop. But then, kind of starting mid 2017, Canadian dollar started to get better. And what we attribute that to is, again, a lot of negative sentiment from tariffs was being priced into the Canadian dollar. And then when the market realized that the imposition of tariffs wasn't going to be as harsh, Canadian dollar actually recovered what it lost and then some. And it actually hit 80 cents at one point in 2017. So where we think about where we are today, we've got a similar situation. Sorry, looks like another question. Ian, go ahead.
You're bang on. Everyone's got questions about the dollar these days. This question is a little bit more to do with how we adjust our portfolios in reaction to this kind of data. Like, how do we, as portfolio managers, take this information and really implement it on behalf of clients within their portfolio?
Yeah, that's a great question, and actually deserves maybe just a separate webinar. So, when we invest, as I said, we've been leaning into the U.S. equity market. What we want to also be mindful of is potential currency movement while we're invested in the U.S. So I'll give you an example. So let's say we own Alphabet stock, and let's say in 2025 we expect it to go up 15%. If we were to just buy it in US dollars, on a US dollar basis, it's gone up 15%. But let's say our currency expectation is that Canadian dollar is going to recover and maybe even rally a little bit. So let's say the Canadian dollar we expect is going to go up 5% from where it is. So as a Canadian dollar investor, we gain 15% on Alphabet stock price, but then we lose 5% on the currency. So we've only made 10%. So what we do is for about half of our US exposure, we're actually able to hedge out the currency impact by buying that Alphabet stock here in Canada on a hedged basis. And this is a new development that started about 2 years ago. They're called Canadian Depository Receipts, where we can buy Google shares. They trade here in Canada, not on the TSX, but on another exchange, fairly liquid. And the advantage is that it's hedged for the US dollar, so that if Alphabet goes up 15% in US dollar terms, what you'll see on your statements is that your investment in Google in Canada has also gone up 15% in 2025. So that currency impact gets completely immunized. So that's how we treat it. Now, we don't hedge all of our positions. About half of our US exposure is hedged. And that's how we manage it. So it gives us some exposure to the currency, but what we do is we eliminate a lot of the volatility in the currency from the returns. Does that answer the question, Ian?
I think so. I think that's a great explanation and really interesting how that portfolio, it's not really just the asset allocation that you have to look at in terms of your geographic exposure. You really have to think about that currency component as well.
Yeah, that's right. Exactly. And as you can see in the past 10 years or so here, the Canadian dollar has fluctuated, at times from as low as 70 cents to as high as 80 cents. And if you're caught on the wrong side of that currency, it can really impact your portfolio returns materially. Okay, so just to finish off the discussion on this discussion on the Canadian dollar, so our feeling is that there is a lot of negativity baked into the Canadian dollar. We may see some further short-term weakness, but as we look further into 2025 and those negotiations on tariffs start, and the market gets more comfortable, we may actually see the Canadian dollar strengthen back, maybe to the middle of this 70 to 80 cent range. Okay, I'm going to speed up a little bit here because I did want to talk about some things to do specifically with the portfolio at the end of the presentation. So really quickly here, valuation. So I'm sure many of you have been hearing, that the markets are hitting new all-time highs almost on a daily basis. So valuation has always been important to us, and it will always remain important to us. Where we find the U.S. market right now, and in this case, the S&P 500, it is trading at a fairly lofty valuation multiple, 22.3 times. But when we invest, we're not investing, of course, just in the market. What we've been adding exposure to recently are things like small caps, which are not reflected in the S&P 500. We've been adding U.S. banks, which are trading at a much lower valuation multiple. So overall, the market is a little bit expensive. It may remain expensive here just because if the U.S. is perceived to be the only game in town for the next little while, it is attracting a lot of foreign capital, and that may keep valuation multiples elevated at these levels going into 2025. TSX, relatively and from an absolute perspective, not very expensive at around 15.5 times. So we don't share those valuation concerns as much here in Canada. I'm going to just really quickly mention inflation. I think in the last webinar I said I may never talk about inflation again. Inflation is back to target in Canada. It's the last reading headline inflation was at 2%. That's what's giving the Bank of Canada a lot of room to cut interest rates. The real focus for central bankers these days is what's happening with the economy and specifically the labor market. So as you can see here in the US, the unemployment rate had been rising, but it's leveled off at around 4.1%. Again, we get another reading tomorrow, but the soft landing scenario, which means that the economy is slowing down but not crashing, that seems to be unfolding here. We've seen the unemployment rate rise a little bit, but it's leveled off. It's not rising very sharply as it has in previous economic cycles. And with rate cuts starting, they are starting to take some of the pressure off, and that stimulus may but may actually further facilitate that soft landing scenario. In Canada, the unemployment rate has risen a bit more sharply than in the US. We're up to 6.5%. That's about 1.5% higher than where it bottomed out a couple of years ago. But again, as you can see in red there, Bank of Canada rate starting to come down. That is what is expected to lead to a more flattening of the unemployment rate as we look into 2025. Some of you may think, well, we've seen this rise in unemployment. Why hasn't a recession started yet in Canada? We got very close, as you'll see in a moment. But again, with rates starting to come down, and we have to remember that in Canada, a big contributor to the economy is the real estate market, which has been in a recession. A lower rate environment continuing into 2025 should start to stimulate that real estate market, and we're already starting to see, some monthly stats showing activity starting to pick up. That is going to contribute to the Canadian economy and should again lead to that soft landing scenario. And looks like another question. Sorry, I can't hear you. I can't hear you, Ian. Try again.
Hey,
Okay, right. little technical difficulty. We'll come back. Okay. Let me, I'm just looking at the clock here, so I'm going to fast forward a little bit. Okay, so economic outlook in the US. So when we put together the dozens of economists that put out projections for GDP growth, what it shakes out at is that the US economy is going to continue to grow, but perhaps at a slower pace into 2025. Again, a lot of this is subject to change based on the policies that actually get enforced. But from the current situation, if anything, these numbers in the US are likely to go higher, not lower, based on the policy initiatives. In Canada, what some of you may be, again, surprised to see is that economists are actually expecting Canadian GDP growth to accelerate a little bit as we look into 2025. Now, again, some of these estimates from economists may have been that maybe they're not factoring in potential tariff implications. Maybe they're not factoring in a bunch of other policy initiatives south of the border. But the overwhelming consensus across the economist base is that the Canadian economy should actually start to improve going forward. And again, the main reason for that, or main driver, is that interest rates are coming down much more rapidly in Canada, which should have that stimulatory impact here in Canada. All right, I think we've got Ian back now.
We're going to try this again, Himalaya. Can you hear me now?
All right, yes, I can.
Perfect. My left AirPod died midway through our call, and for some reason I cut out the microphone there for just one though, just one. The right one's still going
those
strong.
AirPods.
I know. So I guess the real question, I think you've answered sort of the last two questions here already. The first one had to do with the sham rule and recession and unemployment. This one more has to do with the Canadian GDP outlook, and I think it's very surprising for people to read the headlines around productivity. And the diminishing, really scary headlines, the diminishing rates of return around productivity here in Canada, and then see this economic forecast that we're seeing here in front of us.
Yeah, and you're right. It is a good question. And what these headline GDP numbers don't, the story that they don't tell you is things like GDP per capita. The reason why the Canadian economy has basically avoided a recession up until now is overall growth in the economy has been growing because our labor force has been growing. And a lot of that has had to do with immigration over the past 2 or 3 years. So overall, the Canadian economy has been growing at, in terms of positive, at a positive growth rate, and may continue to. But on a per capita basis, when you factor in that there's a lot more of us, on a per capita basis, growth has actually been negative for the past several quarters. So that is an issue, and I agree, productivity is something that has plagued the Canadian economy for quite some time. I think of it more optimistically from hey, that's room for improvement. That either the existing Canadian government administration or perhaps the next could enact, things like a better set of tax policies to encourage that level of productivity that we need.
Let's hope, Himalaya. Let's hope.
Sorry, I'm just getting over a cough, so I just had to swallow another lozenge there. Okay, so what does this all mean for the portfolio? When we think about the outlook for 2025, the big picture again is soft landing. Sorry, a sip of water here too. Okay, better. So soft landing is our overall thesis when we look into 2025. We talked about the key drivers of that. Interest rates are coming down. Inflation is back under control. Consumer confidence is steadily rising. maybe not every month, but the direction and the trend is up. And then on top of that, we have these added wrinkles in the form of Trump 2.0 policy initiatives, which are opportunities in some parts of the market, potentially challenges in other parts of the market. What that all, we distill all of those drivers with the added uncertainty of the U.S. Election. What that has gotten us to do is lean further into the equity market. So we had been doing that even before the election because we knew that regardless of the outcome, those tailwinds of interest rates and things like that, those tailwinds would continue regardless of who was in the White House. We added further equity exposure in the US post-election after Trump 2.0 expectations because we see them as being even more friendly to the U.S. equity market. So that's our broad 2025 outlook. When we think about our asset allocation across our main 60-40 model, and again, I remind everybody that this may not mirror your portfolio exactly, but our broad thinking has been in the first half of the year, we were cautious. The probabilities of a recession were high and rising. We were reducing equity exposure. We got as low as 47% in the summer. But since then, we've been steadily adding, and we have continued to add even after the election. So two things here. One, we've raised equity exposure. We're slightly overweight equities now. And when you look at where that equity exposure is, most of it is now in the U.S. So 40% of our portfolio is weighted towards U.S. equities, and we've actually reduced moderately our Canadian equity exposure. Still maintaining some, like I said earlier, Canadian banks. We still own CIBC and BNS. They are net beneficiaries if those deregulation efforts come to fruition. All banks would. So that's an example of why we want to maintain some Canadian equity exposure as well. At this point in the final few minutes, maybe I can dig a little deeper into some of our portfolio positions that we've either held for some time or we've been adding more recently. So I want to focus a little bit more on technology. So technology has always played a role in our portfolio, either direct names, as Gord had mentioned. At one time earlier this year, we owned NVIDIA. We made a lot of money on it. We traded out of it in favor of a more broader approach to the artificial intelligence theme. So our exposure to technology continues to evolve. So rather than take a single name approach that, we're going to buy this stock or this stock, what we decided to do was have a more broad exposure. So we still have direct positions in core names like Alphabet and Microsoft. But what we have realized is that a theme like artificial intelligence and technology in general is that it's changing very, very quickly. And what we don't want to do is pick stocks that may not be the main beneficiaries of where the trend is going. So what we've decided to do is invest and build large positions in two particular funds. One is Fidelity Global Innovators. The other is Dynamic Power American. And their focus is, they're not exclusively technology, but they are heavily weighted to technology. And the portfolio managers there are a lot closer to the trends than we can ever be, because that is really what they do day in, day out, to the point where the portfolio manager at Fidelity actually relocated from Canada, now lives in Silicon Valley for the last couple of years, just to be closer to the trends, because they are evolving so quickly. So again, big picture, we think artificial intelligence, still early innings. Think of the development of a PC. At this point, we've only built the actual PC and maybe the chip, but software is a value add on that PC. And then what people actually do with a computer, that's really where a lot of money is to be made in the future. So if we apply that to artificial intelligence, so far the winners have been, companies that have built out the cloud, where a lot of the data is stored. The other winners have been semiconductor companies that are actually making chips that do all the processing. But when we think about longer term, it's the infrastructure around artificial intelligence. It has to be used for a purpose, and that purpose has to either result in higher revenue for somebody or lower costs. And we see that opportunity as being enormous, and that opportunity is going to be well beyond just the technology space. It could really apply to every industry in the marketplace, and even to consumers. We might not be there yet, but the ability to have the advantage of artificial intelligence on your phone to speed up tasks, that opportunity, I think, is still well in front of us. So again, rather than us trying to distill down these rapidly changing developments, we decided to stick with a few core names that are going to play a long-term role, like Alphabet and Microsoft, and then also invest quite heavily with these actively managed funds that are able to adapt portfolios a lot more rapidly than we can. And just to give you an idea as to what's going on in the technology space and why artificial intelligence, in the last 2 years has emerged and is capturing all the headlines. Many of you may have heard of this this law called Moore's Law. He was actually an executive and engineer at Intel back in the 70s, maybe even the 60s. And what he saw was that the trend and the technological advancement of computer chips was that every 18 months or so, he saw a doubling of capacity. And that has actually, that's actually what has happened, not just in the last 35, 40 years, but even back when you go back into the 50s and 40s and 30s, think about the advancement in computer chips and processing power. His law actually was very prescient. I did the math on this because I'm a nerd. It's actually doubling right now at a pace of around every 16 months. It's doubling. So again, big picture, what does this all mean, and what's the opportunity? It's because of the faster processing power. That's what is one of the key building blocks of artificial intelligence. Artificial intelligence requires a huge amount of processing power to occur. Could not have existed 20 years ago. Computer chips were just not fast enough to compute and enable artificial intelligence. So we've got the processing power. The other key building block that we have that we didn't have 20 years ago was the cloud. A lot of data, if you remember back 20 years ago or 30 years ago, all data was stored on your own computers, or businesses used to store all their data, on a hard drive somewhere in a back office. Most data now is held in the cloud. So when you have the combination of data that's kind of centralized, and you've got these chips that can process at a much, much faster pace, you put those two together, suddenly that enables artificial intelligence. So that's where we are right now, early innings. There's a lot more opportunity ahead, and again, it's a big focus for our portfolio. I want to highlight two other portfolio holdings that are fairly large in our portfolio. Alphabet. This has been a position that we've held for quite some time. Many of you may have seen a lot of headlines recently. This, again, I mentioned, the highly regulated environment that we have just gone through. So specifically with Alphabet, the Department of Justice in the U.S. Has been on their case for accusing them of monopolistic practices, meaning their Google search is so good that they basically own the market. and other competitors, just don't have enough market share. So suddenly that's a problem. They lost the case. A judge found them or ruled against them, against Alphabet, and said, yes, you are monopolistic. So some of the remedies that have been talked about are, on one extreme, are talking about breaking up of Alphabet. The stock price has been volatile over the past couple of months as these headlines have appeared, but every time a headline comes out, it reacts negatively, and then give it a few weeks and it has recovered. When we look at the situation and we read what analysts are saying, one thing that really stuck out to us is that let's just think, hey, let's say every ruling goes against Alphabet and they are broken up, meaning they have to spin off or sell YouTube and Google Search and Android and some of their emerging businesses like Waymo, the self-driving cars. If they were to have to do all of that, the company would actually be worth well higher than where the stock is trading today. So even in a worst case scenario, we see plenty of upside in a name like Alphabet. So what did we do? We took advantage of the weakness recently and we added to our position. Ian, looks like there's another question.
Yeah, we got another one on technology here, and Google, great name, probably hopefully going to put a lot of presents under some people's trees this year. The question is about crypto, and a little bit related to the last slide that we saw there. Obviously, Bitcoin going through $100,000 earlier today, falling back down below that, but has to do any of those portfolios, managers that we mentioned, have exposure to crypto in any way, shape, or form?
So the simple answer is yes. They don't actually own crypto in their portfolios, but they do own. They do have indirect exposure to companies like Coinbase. They have indirect exposure to other either companies or technologies that are correlated to what's going on in the crypto environment. So simple answer is yes. And again, it's not something that we have invested in because, frankly, we still haven't come up with a fundamental thesis as to what drives the price of crypto. Like we can understand what drives the price of Alphabet stock or Bank of Nova Scotia or Enbridge, but until we can come up with a model that tells us what the fair value is on something like crypto, we're going to avoid it. But to answer the question, yes, there is some indirect exposure, not enormous, but there is some exposure in these two funds to crypto.
Interesting. Thank you.
Okay, just last couple of slides. Just want to highlight one other name, Citigroup, which is also a core holding for us in the portfolio. So it has performed very well, as all banks have recently and even on a year-to-date basis. But what's going on at Citi is a complete restructuring. So it's been kind of the black sheep of the U.S. banks. It's had a very far-flung footprint globally. It's not the most efficient. It's had some internal control issues. But the new CEO, Jane Fraser, who was brought in 3 years ago, that's been her task, is to basically get Citi back into the good books. So they've shrunk. They have been shrinking their global footprint. They've invested heavily in internal controls. They have been raising their operating margins. And what's happened is analysts and investors, their sentiment has been improving on it. So that's all good. But the U.S. bank sector as a whole has been moving higher at the same time. So the discount that Citigroup trades at compared to its peers, that discount is still very large. So even though the stock has done really well, we still see a lot of good opportunity in a name like Citigroup as that sentiment keeps getting better. Even if the U.S. banks don't keep moving higher, there's a lot of room. It trades at about a 55% discount to its peer group. So there's still lots of room for them to narrow that discount, which would lead to or which would be driven by a higher stock price. So that's just again another one of our core holdings in the portfolio. We've held it for some time. Pays a great dividend, and again we see a lot of upside potential. So let me end it there. I see the time at 6:03 p.m. I've gone a few minutes over. I'm going to hand it over to Ian for some closing remarks.
Well, thanks, Himalaya. That was great. I know we didn't get a chance for all the Q&A at the end here. So if you do have another question that you want to post to Himalaya, do reach out to anybody on the team, and they're happy to go over it with you and make sure that we get the appropriate response. It has been a good ride in the markets this year, and I think there's a lot of people on the team that are unsung heroes of that. I think it's been so. Thank you to Himalaya. Thank you to the rest of the team for the great work that you've all done with all of our clients this year. It's been a great ride in the market. Great job of the portfolios. So thank you very, very much. We know there is lots of still concern out there. So if there is anything on the top of your mind that you're concerned about as we head into the holiday season, please reach out to anybody on the team. They're happy to review it and make sure that we get a proper answer for you. Thank you all for all of your amazing support this year. This has been a phenomenal year for not only the portfolio, but also our business. We continue to expand. I think we're going to have some really exciting news for everybody in the new year as it relates to our team. And we really, really thank you. We hope everybody has an amazing and safe holidays this year. And we look forward to being back with you in the new year if we don't get a chance to chat. Thanks, everybody. Have a good one.